So for the first time, there is a debate and there is perhaps a deliberation as to whether 50 is right or 25 is right, because we are going through that phase of the market, because for the first time Fed would be cutting rates post COVID, and do they want to start slow or do they want to start strong and then ease it out? Now, it's anyone's guess that what would be the short-term reaction, and I'll tell you why. Because purely looking at the market positioning, stocks at an all-time high, bonds are at levels where they're factoring in a series of rate cuts from now to next December, and commodity markets are the only one which in a sense have not moved in a very typical manner. Now, I personally feel that 25 is better than 50, and I'll tell you why. Because 50 means that the Fed in a sense does not feel very strong about the economy. Otherwise, Fed would not suddenly start with a 50 bips rate cut. The history of Fed is that they always start with 25. It's only in cases of emergency that Fed has resorted to 50 basis cut. So if a 50 comes through, in the medium term, it is good for emerging markets. In the long term, it would benefit a country like India. But in the short term, for me, that really could be an indirect profit warning or an indirect red flag from the Fed. The positioning of the market is such that markets are at an all-time high, and if the Fed communication is not what everybody is anticipating and expecting, we could see some numbness going forward, at least on the Wall Street.